I would like to invite Dr. Chiraga Chakravarti on stage.
Commodity market as such is quite a bit different from the equity market. The commodities market, it's not only the derivative part, but it has got various other markets which are given in the circle. And to regulate this, there are regulators on the various angles. Now, if you want to compare the markets or what's happening in India and what's not happening, what's happening in other part of the world, the commodity classes, the products which is available, we have internationally we have products on agriculture, livestock, energy, base metal, precious metals, weather, freight, as Mr. Roshan said, emissions, basic chemicals. In India, we have agriculture, energy, base metal, precious metals, and emissions to some extent. Now, giving that background, once again, I just want to take you a little bit time to see these three slides. One is an S&P 500 index, which is depicting one asset, and copper spot is another asset class, and Euro USD another asset class. But if you see the fourth graph, which talks about returns, copper spot changes are very, very, very volatile. What the point I'm trying to bring home here is that all markets which is developed or has a volatility inherent in the market. And this is the main theme for my presentation, is that how do you iron out volatility from your portfolio? Because volatility cannot be ironed out from market. It will be there, it will be very much part of it. So what risk management tool or risk management techniques you require to iron out the volatility from your portfolio? The thing is that we cannot forecast market. Whatever mathematical models you try to use for forecasting model, market is a different ball game. So the best thing is that try to hedge that. And it's also that you cannot be away from the market. You have to be in the market, but at the same time try to hedge it with various tools and technologies. So how do you tackle the volatility in the financial statement? Taking a position in a derivative market that is opposite position in the physical market. It reduces or limit risk associated with unpredictable changes in the price. So this will lead to the second point, which I just said. The third point, the objective behind this mechanism is to offset a loss in one market with a gain in another. So that's why hedging becomes important. But if you say that I am not in the other market, I am there in only the derivative market, then the third point will not be true for you. A temporary substitution of futures market transactions for a planned cash market transaction. So these are the basic four things which is required for when you try to do hedging. And when you do hedging, as you said, it protects against the price risk, lock in the profit, better inventory management, better planning for cost management, competitive pricing for finished product, aids to decision making, due better control over the prices. It always helps. When you do a risk management, you have to follow a process. You should have a strategy, you should have policy documentation, you should have MIS, you should have a proper regulation as well as internally as well as externally. Because in a new regime of accounting, the hedging or the risk management becomes a big thing, and that has to be documented and told to everybody that the hedging which you have done is absolutely perfect. To come to a hedging process on a macro sense, what all factors should be taken into consideration? First of all, decide whether you want to hedge or not. Then once you have decided that the hedging is required, what are the type of risk and how do you measure that? There are various methods to measure it. But first identify, measure, that is quantify the risk. Once you have quantified the risk, do something called back testing. Go and calculate a hedge ratio and basis pattern. Once you have done that, then discuss this hedging plan with those involved in the entire process. And the last point, methods for measure hedge effectiveness of the portfolio. Friends, this becomes a very crucial point now, because if you're talking about new accounting norms which will be coming in picture now, IFRS. So if that is the case, then your hedge effectiveness should be very crucial. Whenever I go to a corporate, they said, who should do the risk management? The chief risk officer, which has become a very key point in any corporate for a risk management point of view, is because this person has to take all the view from the risk management point of view and from a hedging point of view. So I think that's it from my side. Thank you very much for this. Thank you.
Thank you, Dr. Chakravarti, for taking us through the mechanisms of managing risks and hedging risks and dispelling some of the popular myths surrounding hedging. Now, moving on to our theme, how to navigate current trends in gold and crude. And I would like to invite on stage Mr. Naveen Mathur from Angel Broking.
Well, good morning, ladies and gentlemen. The outlook will not make all of us or do miracle in a day or so to make us millionaire here. I think there are a lot of fundamental issues, and we believe these fundamental issues drive the prices of gold particularly. The fundamental issues which we all know today are something to be talked about are the economic scenario in the global markets, the sovereign debt in the Eurozone, the Chinese economy tightening up, a lot of things. The UK markets are not coming back from the recessionary trends. So all these factors are embedded into the prices of gold. And if one understands what are these factors and why they are actually taking the price as either upways or on the downways, they can really understand the movement of the prices, and particularly in gold. The last 3 years particularly, the 2008 and 2009, has really taken a spurt in the demand of the ETF. Means we all have heard about these exchange traded products, the ETFs, which are purely and purely trading in gold. There are certain specific in India also, like Kotak B's and the benchmark gold ETF, which has an underlying gold in the physical vaults. And what are the prices the physical markets behave in? They have their ETF NAVs derived from the physical market prices. So the ETF demand actually boosted up the demand in total. But then actually the demand per se of the jewelry has went down. It has not increased to a very large extent. Only in India the jewelry demand has increased, because we have started understanding that, and India being one of the largest consumers of gold in India, of the world, we have started sinking into this kind of territory of 17,500, 19,000 levels of gold. The other major factor which really impact the gold prices is the currency factor. Means we all know that the currency versus the US dollar and the prices of gold are inversely related. At the same time, if one understands the euro is directly correlated to the prices of gold. Now, one really has to understand how the currency movements are shaping up and how the dollar and the euro is shaping up in terms of the currency to understand the price of the gold in a longer term perspective. Crude is the other commodity which talked about, and I think crude is also to a very large extent dependent upon how economic scenario is shaping up. If we have depressions, we have recessions, the people will not go into vacations, the crude oil demand will differ, the manufacturing demand of the crude oil will differ, and therefore the prices of crude will come down. But in turn, if the recession and everything works very well in terms of growth, means the recession turns into the growth platform, I think the crude oil prices takes an uptrend, and that's why the crude oil demand goes up and the prices takes an uptrend. Economic concessions, the recessionary trend which is still continuing, people are uncertain about how the Eurozone sovereign debts would come out and will venture out to be in the years to come. So I think that particular correlation will have a strong bearing on the prices of crude. And since the economic activity is not that great after this slump, after this great recession rather than Great Depression, I think the prices on crude oil would range between $70 to $85. Thank you very much.